So this is being recorded on the first trading day of 2026. Today is January 2nd, and the market over the past year is up about 16.6%. The past 5 days, it's actually on a downward trend, 1.32%. And today, the market was off to a pretty decent start. We had some gains, and it's kind of lost some steam and lost those gains. And we're basically breaking even for the day today. So what we're going to do is sort of give you some insight into what the Interflame portfolio looks like. We're going to show you some of our positions, some of our holdings, and we're actually going to add on to those holdings today. And so we're going to go through that. We're going to go through some intrinsic values. And all that we ask for in return is that you like this video if you get anything out of it, subscribe to the channel, tell your friends, tell your family, tell your mother-in-law. Let's spread the good word about the Interflame Finance methodology, and let's get everybody building wealth in 2026. So if you're new to this channel, what we do is we look at different companies with different themes, and we rank them on a score between -10 and +10. -10 is absolute garbage, +10 is the best company in the world, 0 is neutral. We aim for companies that score 5 or higher on two different metrics. We look at safety and we look at growth. So right here we have our safety, and we're going to start with we're going to start with all of our scores. We'll look, these are some of the holdings that we have in Interflame portfolios, and we've scored them based on some safety metrics that we'll go through in a bit. But CPRX, that's a pharmaceutical company, they're coming in at 7.9, as is Decker. They are a clothing brand, they make shoes. DHI is real estate. Johnson & Johnson and Merck all coming in at 7.9s at the top. We have EXEL, we have Target, United Health in the 7s. We have Microsoft and SM, an energy company, in the mid-5s. We have First Solar, Google, Meta coming in at 5s. And remember, this is safety. So a lot of these plays down here are in no way, shape, or form safety, mainly because they don't pay dividends. And so we have Amazon, XYZ is Blockify, or rather Block. We have NVDA, and we have Micron in the 4s. Like I said, we typically choose companies that score 5 or above. We will look at their growth scores in a bit to see how they stack up for growth. We would expect to see some of these companies down here scoring lower in the safety, being higher in growth, mainly due to them not paying a dividend. If we look at the numbers, we look at Amazon, we see that they have a PE of 32.6. They are trading a little bit rich, but the 5-year forward PE is a 12.7. On this channel, we've said it many times, but we really enjoy the 5-year forward PE. Amazon very rarely trades at a discount. It's usually trading at a premium because they are such a solid company. And so what that 12.7 5-year forward PE is telling us is if we were to buy Amazon today, we're basically getting it for a 12.7 multiple. And we'll look at their growth, their expected growth in a bit. We do expect Amazon to grow due to AI, due to their Amazon Web Services, their cloud computing, their selling to customers, and their Amazon Prime streaming platforms, in addition to all the other businesses that they're invested in. CPRX, they have solid numbers across the board. They have free cash flow yield at 8.2%, 5-year forward PE coming in at 7.8. We have Decker, solid return on invested capital, solid return on assets. We have DHI, the home builder, dividend growth of 26.9%. They have grown their dividends for 11 consecutive years, dividend yield at 1.3%. We expect DHI to do well if the environment for housing improves in the year 2026 and definitely in 2027, mainly because the housing market has just been so frozen for the past couple of years. Currently, their PE is very low at 12.4, and it's cut in half basically at a 5-year forward PE basis. That's if they can execute on their growth. Exelixis, the oncology cancer drug company, they have very, very low debt to equity. And the numbers for the PE ratio for a high growth company, fantastic. And then the 5-year forward PE coming in at 5.6, fantastic. First Solar is a holding it's a position that we started back in 2025. We've seen tremendous gains in the solar sector. In particular, First Solar has treated us very well. And we see that they're coming in at a 5. So they're at the lower end of what we would consider. We will compute their intrinsic values in a bit and see how they perform. Google also trading a little bit rich at 30.9, but they are a high growth tech company. And we see that based on their projected growth, they're going to come in at a 14.1 5-year forward PE. Johnson & Johnson, 64 consecutive years of growing their dividend. They are not only dividend aristocrats, they are dividend kings. Currently a PE of 20 and a 5-year forward PE at 10.9. Meta, that's Facebook, that's Instagram, that's Threads, all that stuff, WhatsApp, Messenger, trading at 29.2 for PE multiple and 17.05 5-year forward PE. We have Merck, another holding that did pretty decently, 13.9 PE currently, 9.4 on a 5-year forward PE basis. They do offer a dividend at 3.2% and a dividend growth at 5.1%, and they have grown those dividends for 15 consecutive years. They're hopefully going to do that. We look at their payout ratio of 44.9%. It's getting a little high, but there's no reason to suspect that they may start cutting their dividends. Microsoft, solid company, 5-year forward PE at 14.8. That's fantastic if they can execute on that growth. MU, you know that this is one of our holdings that we tripled our position. We tripled our value in 2025. They went up more than 200%. Currently, the PE is 27.1. However, their 5-year forward PE, if they can grow in line with analysts' expectations, is coming in at a 5.2. That's something that we're definitely going to look at in this video more carefully. NVIDIA is coming in at pretty solid numbers, a 9.1 5-year forward PE. They do offer a dividend that's basically 0%. I think it's 4 cents per share. They have grown their dividend 17.7% for 2 consecutive years. SM, energy company, solid PE at 3.0. 5-year forward PE at 4.8. So they are increasing on the multiples, which may not be a good thing. They have negative free cash flow yield, also something to give us some concern. Target coming in at a PE of 11.9. 5-year forward PE basically flat at 11.0. We have United Health. Solid numbers across the board. They were beaten down. We bought at the dip. We bought the lows. And we are seeing gains in our portfolio on United Health. And finally, Block. Decent numbers, 8.8 5-year forward PE. So those are the safety scores. We're going to look at some growth scores because a lot of these plays are growth companies. These are not safety collecting solid dividends year after year. We want to also compare these to how they are expected to grow in the coming years. So just as a reminder, nothing that we say on this channel is financial advice. I am not a certified financial advisor. I am not giving you any advice. I am not telling you to buy, hold, or sell anything in your portfolios. Always do your own research and do your own due diligence when investing your hard-earned money. This video is for entertainment and informational purposes only. If we look at the growth scores, we see at the top of the leaderboard are the 2 biotech companies, pharmaceutical companies, CPRX and EXEL. We have NVIDIA coming in at 7.8, Decker, First Solar, Meta, Microsoft, and MU coming in at 7.2. We have Google and Johnson & Johnson at 6.7s, Merck at 5.6, and DHI, the home builder, squeaking in at a 5. Amazon, we've talked about this in past videos. We don't think that this 4.4 truly reflects the growth that Amazon will see, and we will see whether or not we want to purchase Amazon today on based on its intrinsic value. Okay, so we'll just go through these a little bit more quickly. All of these companies have very low debt to equity. That is one of the major features that we have on this channel. We tend to choose companies that have very little debt compared to their equity, mainly because we want them to be able to survive any sort of pullback in the market, any sort of recession. So if revenue dries up, we want these companies to have cash on hand to pay their bills, pay their debts, and stay open. We certainly do not want any of these companies to go bankrupt. If we look at CPRX and EXEL, we see that they are fantastic companies, at least as far as these numbers are concerned. Very low debt to equity, profit margins of CPRX at 38%, free cash flow yield at 8.2%. This is trading at a 7.8 5-year forward PE. That's phenomenal. EXEL, very similar and very strong numbers. We have profit margins close to 30, return on equity and invested capital pretty high in the mid-20s to 30s, very low debt to equity. NVIDIA, Decker, First Solar, Meta. I mean, these are just solid companies. If you need to, you can pause the video here, check out their revenue growth, check out EPS growth. Again, here's Micron, expected to grow 39% every year for the next 5 years. We will not be using that number in our intrinsic value calculations. Instead, we are going to use something closer to, I believe, 25% for 5 years, and then we cut that in half for years 6 through 10. We'll give you details on that in a bit, but we do err on the side of caution. We do want to be a little bit more conservative on this channel, a little bit more cautious with our money. So we will not be using 39% for MU. And as it goes for NVIDIA, we will not be using 38.5%. Instead, we will be using 30% growth for NVIDIA when we compute its intrinsic value. Now, being able to compute the intrinsic value of a company is one of the most important things you can do as an investor. You are guessing, you are estimating, but you are making educated guesses. You are making educated estimates based on what the company has done historically and what analysts and you, based on your research, think a company is going to do. And so in the description of this video, we have 3 links for different intrinsic value calculators. We have one that is the PE multiples model. You see it here. I show you in that video step by step how to build your own free Google spreadsheet that you can make and you can use yourself to compare and value and evaluate our companies that we have on this channel. You can use different numbers if you disagree with our numbers, and you can also do companies that I don't feature on this channel. So that is one of the most important tools that you can have in your toolbox. So the PE multiples model, that is in the description below. We also have a dividend discount model that shows you if a company pays a healthy, solid dividend, what is that company worth in the future? And we also have the discounted cash flow model. This is sort of the most popular, the sort of gold standard intrinsic value calculator out there. I highly encourage you to build out your own intrinsic value calculators. Follow those videos down below, and you can do this for yourself, and you'll become a much, much more sophisticated, much more informed investor. So again, just a quick reminder, nothing that we say on this channel is financial advice. We're not telling you to buy, sell, or hold any of these companies, but we'll just get into it. United Health has a growth score of 3.3, pretty solid dividends, so they come in with a safety score of 7.1. That gives us an average score of 5.2. When we run the intrinsic value calculations, we estimate that United Health is currently $409 per share. It's trading for $337, so that gives us a 17.7 margin of safety. Target is coming in with an average score of 5.5, very similar to United Health. They pay a solid dividend, no real signs that they're going to cut that dividend anytime soon. Their growth is slightly higher at 3.9, giving us an average score of 5.5. Intrinsically, Target's probably worth around $113, currently trading for $100. That gives us an 11.2% margin of safety. Micron, we think that Micron is a solid company. They are a solid growth company. We were very cautious and very conservative in those growth numbers. Again, we used, I believe, 25% for the year over year, or rather the 5-year annualized growth. So way, way, way under the analyst expectations, somewhere in the 40s. We think that Micron is a solid company, but they've done most of their growing back in 2025, where we tripled the value of our investment. Currently, Micron is trading for $312. Intrinsically, we think it is worth $340. Now, Google is the first company we're looking at. Yes, they have a solid score at 5.85. That does come above our threshold of 5, but intrinsically, we think they're worth $313. They're trading for very much, or pretty much that value at $314. That gives us a negative 0.3% margin of safety. Now, when we look at intrinsic values, we do not buy something when it's fair valued. We want it at a discount. We want to buy it cheap, so that way there's more room for us to grow. And so if you absolutely had to buy Google, now might be a time because it is fair valued. It's not overvalued by much, by $1 per share, but perhaps Google might be a better buy when it comes down later, if it comes down later. NVDA, solid 41.3% margin of safety, very high score at 6.05. Safety, not so much because their dividends, nothing to really speak of, but their growth is solid at 7.8. Intrinsically, we think they are worth $322, currently trading for $189. First Solar, again, we think most of their growth happened back in 2025. We bought heavily in early to mid 2025. Price is currently $275. Intrinsically, we think they're worth $304. That gives us a 9.5% margin of safety. Meta Platforms, very similar in score, 6.1 on average. They're currently priced at $652. Intrinsically, spot on $652. No margin of safety. We're probably not going to buy Meta today. Now, DHI, price currently $145. Intrinsically, we think if the federal funds rate comes down and we see sort of a loosening up of the housing market and we start to see people actually buying and selling homes again, intrinsically this company could be worth $209. Solid margin of safety of 30.6%, average score of 6.45. Microsoft comes in high on both growth and safety. Intrinsically, $500 per share. Price, $472. That gives us a 5.5% margin of safety. Merck, Another one we're not going to buy because they are trading at a premium today, currently valued at $94, trading for 106. They do have a pretty high safety score due to their dividend payouts, but we want that price to come down before we consider putting it into our portfolio. Johnson & Johnson, a nice healthy 13.4% margin of safety, coming in at 7.3 on average. Very high safety score because they are dividend kings, and they do have some growth ahead of them, it looks like. And so we see that company coming in pretty solid, 7.3. Decker, something we're not going to buy, mainly because even though they have an average score that is well above 7.5, we do see that intrinsically they are $97, trading for 107. We will hold off and hope that Decker comes down in price. Excelixis, we see that there's a healthy 31.5% margin of safety in that company. High growth and high safety, mainly because they have very low debt. Average score of 8, so that's a solid 31.5% margin of safety. And finally, CPRX. We've been bullish on it for the past few months. We've made pretty decent gains in that in 2025. We think that it's going for $23 per share. We think it's actually worth 30 based on their high growth and decent amount of safety built into their low debt and their strong moat. Therefore, margin of safety of 23.1%. So typically on this channel, what we do is we don't really buy anything that has a margin of safety below 20%. And you can see, based on these hypothetical, if I invested $100 situations, how much would I invest into these companies? So right off the bat, we're not investing anything that has a negative margin of safety. We don't want to buy anything at a premium. So that leaves us with these values. So for example, if I were to invest $100 today, I would put $7 or 7% into United Health, 5 into Target, etc. But again, we like to be picky and choosy. We like to have a large margin of safety. And so I would say to somebody building out a portfolio that wanted to do something similar to this, if you want to have some diversification, if you have very few stocks and you want it to be somewhat diversified, investing in these companies right here would be an okay thing to do. You're buying United Health, you're buying Target, you're buying MU, so you're well diversified into technology, into healthcare, into semiconductors, consumer discretionary, and consumer staples. You're getting some solar stocks with First Solar, so nothing wrong with maybe putting a little bit of money into each of these. But if we wanted to be very careful and not invest in anything that had a margin of safety below 20, then we would erase that, and we would erase that, and we would erase that. And maybe I'll just pause the video. You don't care about me hitting backspace. So there we have it. More in line with our sort of thesis and our investment approach in this channel is not only do we want scores above 5, we also want to make sure that we have a margin of safety larger than 20%. So that really boils it down to 4 different companies. NVIDIA, we have DHI, we have Excelixis, and we have CPRX. And basically between $22 and $28 per company, or 22 to 28% per company. I do want to point out that there's a lot of risk in these 4 companies, especially these 2 very small pharmaceutical companies, $22 or 22% and 28% into just these 2 positions. That's half of your money going into very high risk plays. So that's where the diversification comes into play if you wanted to spread your money out across more sectors, across more companies. DHI, the big question mark is, are interest rates going to come down? Is the housing market going to loosen up in 2026? That remains to be seen. That's a big question mark. And then NVIDIA, a lot of conversation around NVIDIA that maybe they're just sort of circling their money, cycling their money among the AI companies who are in turn giving them money, and they give their money back to the AI companies, and it's just sort of a circle of money. That's a sign that maybe there's a bubble and that bubble might pop. If the AI bubble pops, NVIDIA might see a severe decline in its stock price, short to medium term probably. It's the big dog in the space. It might make a nice recovery, but that might be 3 to 5 to 7 years from now. So we don't know. So putting all of our eggs into these 4 companies is probably not the best idea, but we already have positions in all of these companies. We want to build out positions. And so probably a more prudent thing to do would be to invest money into all the companies that have some margin of safety that's positive and solid scores of average, the average of the growth and the safety scores. So that remains to be seen. Again, entertainment and educational, informational purposes only. Do not buy, sell, or hold anything that we say on this channel. Always do your own research and your due diligence. Check out the link in the description below where I show you how to make your own intrinsic value calculators so you can use your own numbers and do your own research. I appreciate you very much for watching these videos. Please be sure to like the video if you got anything out of it. Please subscribe to the channel so you can keep coming back for more analysis and content and intrinsic values of stocks. We're going to have a series of tutorials going through the basics of the stock market. If you're a new investor or even a moderate to advanced investor, there's always something to learn, always something to understand new in the market. So thanks for watching. Appreciate you. Tell everybody about this channel, spread the good word, and we'll see you in the next video.